Grindrod has delivered full-year profit growth. The marine cargo handling company has posted an 18% rise in annual headline earnings. That's thanks to a good performance at both its port and terminals division and its logistics unit. A final dividend of 38 cents has been declared. This takes the total payout for the year to just over 72 cents and reflects an increase of 84% on the prior year's figure. Sanlam's positive about its growth prospects for 2024. Africa's largest insurer says strong cash generation along with diverse products, market segments and geography position it well to navigate the current macroeconomic environment. Those comments accompanied its year-end results, which show growth of 48% in headline earnings per share. Sanlam's attributed the performance to positive momentum across all divisions, and it's lifted its dividend by 11% to 400 cents. Trellidor has reported a 7% rise in revenue during the group's first half. That's thanks to a good performance from the group's UK division, as it experienced weak demand in South Africa. But these top-line gains didn't filter through to the company's bottom line. Headline earnings per share fell 16%. That's as Trellidor had to shoulder higher borrowing costs. As a result, the group says it will now focus on reducing debt, and so it won't be declaring an interim dividend. Exxaro Resources has warned of a profit slump. The miner expects its full-year headline earnings per share to fall by as much as 30%. That's as the firm had to deal with lower coal export prices. Exxaro will open its books on the 14th of March. Sun International has forecast a surge in annual profit. The gaming and resort giant expects its headline earnings per share to increase by up to 92%. It says Sunbet consistently achieved record income throughout the year and is exceeding its growth targets. Sun International has added that its resorts and hotels have had an exceptional year, which has continued into 2024, while its urban casinos and Sun Slots operations have demonstrated resilience despite a challenging trading environment. Lighthouse Properties has grown its presence in Spain. It struck a deal to buy a retail shopping center in Rivers, which is part of the greater metropolitan area in Madrid. The transaction carries a price tag of 121 million euros, and this will be funded from existing cash reserves. Lighthouse says the acquisition is in line with the company's strategy to invest in dominant and defensive shopping centers in growing regions. Further afield, Hugo Boss warned of much slower sales growth this year and forecast a profit below analyst estimates, which weighed on the company's share price. Let's take a look at this package report for more.
Hugo Boss shares plummeted in its worst session in 8 years. Investors ran from the stock after the German fashion giant warned of much slower sales growth this year. It expects sales growth of 3 to 6%, reaching up to $4.84 billion. It's well below expectations and sharply down from last year's growth of 18%. Hugo Boss's profit outlook also disappointed. The luxury giant forecast earnings before interest and taxes of up to $517.5 million. It's up from 2023, but again below forecasts. Hugo Boss last year continued to benefit from a brand revamp in 2022. That helped draw new customers in Asia and support sales despite weaker demand in Europe. But the company said unfavourable currency effects are now an issue, and it said an increasingly promotional market hurt margin improvement at the end of last year. The company warned its 2025 revenue goal of $5.44 billion might be delayed. It blamed inflation and a surge in borrowing costs hurting consumer spending. The company flagged cautious consumer trends, especially in the UK and Germany. It also saw flatter growth rates in China compared to the wider Asia-Pacific region.
The European Commission will start customs registration of Chinese electric vehicle imports, meaning they could be hit by tariffs from that point if the EU's trade investigation later concludes that they are receiving unfair subsidies. Here's our reporter Ndawling Lachela with more.
That's right, Zinati, and that move could worsen trade ties between Europe and China. Joining me now with more on-the-ground insight is DW correspondent Chiponda Chimbelu. Thanks for your time today. Now, right at the top, talk us through what's currently playing out.
Thanks for having me. Well, Thursday, that is today, the European Commission will start customs registration of Chinese electric vehicle imports. Now, what that means is that Chinese-made electric vehicles could be hit by import tariffs later in the year. The European Commission is investigating whether Beijing's subsidies for electric vehicles provide an unfair advantage to Chinese imports in the European market. Now, this week, Brussels said it had sufficient evidence that appears to point to that. It notes that since the launch of its investigation last October, imports of Chinese electric vehicles surged 14% on the year. So Brussels is launching the customs registration of electric vehicles. Now, that is a preemptive move that could allow it to retroactively impose tariffs on Chinese EVs once its probe into Beijing's subsidies is concluded in November.
And Chibonda, how will the EU's move affect the auto industry?
Well, it may very well make buying a Chinese-made electric vehicle less attractive. While there are still no additional tariffs or import duties, anyone importing Chinese EVs could face the prospect of paying them retroactively. Brussels says that European car makers could be harmed if Chinese EV imports continue at an accelerated pace before the conclusion of its investigation in November. Car makers from China have been increasingly looking abroad for growth to help them offset the slowdown in their domestic market. And that is, of course, a major challenge for European car makers. Not only can Chinese electric vehicle makers produce cars at a discount in China, they also have a better grip of supply chains for minerals needed in car batteries. Chinese electric vehicle makers are the global leaders. They account for around half of the electric vehicle market, and about a third of China's electric vehicle exports head to the EU, according to an estimate by Bloomberg News. So while the EU's move may be welcome news for some European car makers, it isn't going down well in China.
Yeah, surely this move is going to impact those EU-China relations.
The China Chamber of Commerce to the EU has said that it was disappointed. It said that the surge of imported Chinese-made electric vehicles in Europe reflects the demand for them in the market. This could very well affect EU-China trade relations, which of course have soured in recent years. China could retaliate. Beijing has hinted it could respond with similar measures, and it is also conducting probes into some European products. China is also a major market for European exporters, and of course, many manufacturers here in the EU rely on Chinese suppliers in many industries. Any additional trade restrictions will hurt some businesses, both in Europe and China.
Chibonda, let's leave it there. Thanks for joining us today. That was DW's Chibonda Chimbelu.